And welcome back to the show this morning. It is 6:16 as we get things underway. Real quick before we get into the trade deal, I just wanted to comment on something. There was a lot of articles out over the weekend. Best June in 80 years for the Dow, right? Best June in 80 years. Pretty impressive. It was a very strong rally in the month of June. What everybody forgets to tell you, though, is that it also followed one of the worst months of May on record as well. In fact, the entire rally in June didn't even cover up the losses for what happened in May. So it's always important to put these things into perspective, because if you sold the peak of the market in May and then you bought back in June, it worked out really well for you. For most people, you did. I mean, pretty much you're back to where you were back in May. Today, the market will rally. We will set a new high today on the back of this trade negotiation we saw over the weekend. And the question is sustainability, right? Did we resolve anything? I mean, the reason the markets have been struggling over the course of the last year, for the most part, is because of this issue of trade, right? Trade has been impacting earnings. In fact, more companies in the S&P 500 right now are reporting negative guidance than we've seen since 2007. So a very high level of high number of companies, both manufacturing as well as service, beginning to provide negative guidance on earnings going forward, suggesting weaker rates of growth. Now, the issue with this is, of course, the issue of trade is that what markets want is they want a resolution to it. And they want this thing to be over with. So why are the markets rallying today? Well, because the trade negotiations were off. Trump was supposed to institute another round of tariffs. China was going to retaliate with more tariffs if that occurred. So the market's rallying today on relief that over the weekend, both sides decided not to institute more tariffs. Now, it didn't change anything with the current tariffs, right? The current tariffs are still in place. Those tariffs are weighing on farmers and producers and others that those impact directly. So we haven't reset the table. We haven't changed anything from what existed before. The only thing that changed, so to speak, and we'll get into the details here in a second, is that we just decided to keep talking. Now, we've talked about this before on the show many times, is that China is playing a long game here, which is vastly overlooked by most of the mainstream media. I get lots of tweets every day. It's like, China's losing. They're not losing. They can play this game for a very, very long time. If you don't believe me, take a look at Japan. Japan can run an immense amount of debt and stay in the game. And China can do the same thing for quite some time. Yes, trade war is hurting their economy, just like it's hurting our economy. Both sides are paying a penalty for the trade war, which we said would be the case. But there's a lot of assumptions that China's just about to crater and fall in bed. It's going to be like Russia, the fall of Russia, just any moment now. And that's probably not the case. China has a lot of liquidity. They've got a lot of ability to issue debt. They're a state-run economy. So they can keep things propped up here for quite a while and kind of keep the status quo going. And if you've got to pay attention to what is coming out of the Chinese media. This was a statement that was made last week. Lying behind the trade feud is America's intention to stifle China's development. The U.S. wants to be a permanent leader in the world, and there is no way for China to avoid the storm through compromise. History proves that compromise only leads to further dilemmas. During previous trade tensions between the U.S. and Japan, Japan made concessions. As a result, its political stability and economic development were adversely affected, with structured reform being suspended and high-tech companies being severely damaged. China, with a population of 1.4 billion, is the world's largest manufacturing base. Industrial upgrading and its high-tech innovation are crucial to China's economic development. China needs to leave more resources to its descendants by protecting the environment and reaping the dividends of further opening up. These are the core interests of China, and it will never give them up. The only way for a country to win a war is through development, not compromise. To achieve development, China will open its door wider to the world and fight to the end. Now, this was in the Chinese media, but whose words are those? Those are Xi Jinping's own words. That's what he said. This was prior to the trade negotiations over the weekend. And we've talked about this before, saying that China is in this for the long haul. They're not going to acquiesce to a deal that is not good for them over the long term for a president that's only in office for 1 more year, maybe to 3 more years, to 4 more years, right? There's a limited time frame to how long Trump is in office and how long this fight can last. The other thing that will impact the length of the fight is how bad the U.S. economy is hurt by tariffs, which we're already seeing that weakness as well. We've talked about before is that eventually what Trump is going to have to figure out how to do is how to extricate himself out of this trade war and save as much face as possible. And we may have seen that over this weekend. Because it was interesting. The deal that was struck over the weekend in order to get the trade negotiations back on track. Now, again, all they've agreed to is to talk more. That's all they've done. They haven't agreed to anything. There are no parameters or designs around what the negotiations are going to entail. It's simply that, hey, look, we need to start talking again, right? And we need to get this thing resolved and put aside. Okay, I agree. We'll start some talking again. Then they go their separate ways. But the U.S. said, okay, great, we'll talk, but no new tariffs, right? So in order to talk, we won't impose any more tariffs. We'll put tariffs on hold. And we'll give access to Huawei to products from U.S. companies. Now, that's a big give. Huawei is one of the largest companies in China. And Trump came out this weekend and said, well, we didn't really realize how much product that we sell to Huawei. So we'll allow companies to sell some of their product to Huawei as part of this ability to restart. Now, that's a huge gimme because you just took your major bargaining chip off the table. Huawei was the one area that impacted China the most. It had a very, very big impact of these tariffs and blacklisting of Huawei. Now, Huawei's still on the blacklist, but we've agreed to open up the door and let companies like Micron, Intel, and others sell their product to Huawei. That takes pressure off Huawei in the short term. It also takes pressure off China and gives China room to navigate going forward. But again, you've already opened that door. So that was one area that I certainly wouldn't have opened that door in particular, because it now leads to an ability for China to continue to weasel on that door until they get it off the blacklist. Well, if you want to, we'll consider buying more soybeans and do this if you'll take Huawei off the blacklist, right? And this is how this structure's already started. We have already given up part of the blacklisting of Huawei by allowing U.S. companies to sell product to Huawei, and we got nothing in exchange. All we got is, oh yeah, we'll buy some more product from the U.S. Yes, they need to. They've got a massive virus going on with their hogs in China. They need access to more pork. So yes, there will be a pickup in hog supply, which they need, and that we just gave them access to another thing that they need to get access to that was actually hurting their economy. So not only did you lift the ban on Huawei, but you also basically gave them an avenue to get access to more product that they need, which will help the U.S. Now, no, mind you, that this will help the U.S., right? So companies like Micron, companies like Intel, Quovo, others, those will get a benefit from being able to sell product to Huawei. Farmers in the U.S., soybeans, hogs, etc., will also benefit from this as well. So it's a short-term gimme that gives the U.S. a little bit of pickup. Okay, so there is some benefit from this both ways. But we gave China, we said, okay, no more tariffs. We're going to give you access to Huawei. We're going to allow you to buy some of the product that you need from us, and we're going to give you better visa treatments for Chinese students. Now, what did we get out of it? We got a promise that they would buy something that they already needed to buy. That's all we got. We didn't get in. We gave a lot not to get much in return with regards to negotiating a further deal on trade. So again, we didn't come up with a timeline that said you have 3 months to comply with certain things or we're going to institute more tariffs. That's not on the table. There's nothing to rush the process or progress of trade negotiations. And the impact of tariffs, which already exist on both sides. China has tariffs on U.S. products. We have tariffs on Chinese products. Those are still in place, and those are still hurting manufacturers in the U.S. So we really didn't get much out of the trade agreement. So why is the market rallying today? What does the market see? Well, what the market sees and what the market was wanting, the market was priced in for a much worse outcome, which was the talks to break down and Trump to immediately impact more tariffs. That was the worst case outcome that the market had kind of set itself up for last week. And so by the markets coming around and saying, oh, thank goodness, right? No new tariffs. we're gonna go back to talking. We go back to this idea of, well, hopefully we'll get a trade deal done eventually at some point. Now, the question becomes is how long the markets can continue to operate on hope rather than watching what's happening with the actual underlying economic and fundamental data to markets. In the month of June, 90% of the increase in the markets in June were strictly due to valuation. So basically people were willing, what I mean by that is that the prices rose in June, not because of an improvement in fundamentals, not because of an improvement in earnings, not because of an improvement in economic strength, not an improvement in the underlying quality of asset prices, right? The markets rose strictly from investors willing to pay more for every dollar's worth of earnings than they were in May. So that's what we call a valuation rise. So people willing to pay more, people jumping on the bandwagon to chase stocks higher are simply just paying more for actually a base of deteriorating fundamental and earnings quality. So the risk hasn't been reduced in the markets, but in the short term, the markets are optimistic. We will hit new highs today. The question will become, can they stick? Can we hold them? Or is this just another new high that we've seen in the markets over the course of the last 18 months that fails? So we'll watch this today. We'll see what happens. We'll report on it tomorrow on our website. So make sure and get by realinvestmentadvice.com, get registered there, and we'll email you our technically speaking update tomorrow, which will cover today's actions and what we see out of that and how to position and manage for it. Be right back after the break. realinvestmentadvice.com.
Catch Lance Roberts' podcast later at lancerobertsshow.com.